start with the first question. So basically, it's a Indian company, Ganga Limited. So Ganga Limited has earned a profit of 52 lakhs. So they have given the profit that they've actually made in their P&L statement. They have also said after debit and credit. So they have said certain information has already been debited or credited in the books of account. So that's what they have given in the list of items. So the first, they're giving us items debited to the P&L account. So we are going to see that. So there is a list of items which has been given as a debited to P&L account. So we'll go one by one. So basically, the first one is provision for loss of subsidiary, which is around 84,000. And then you have provision for doubtful debts. You have gratuity based on actual valuation. So as we are referring, whenever it's related to a question, each word is probably a keyword. It has some relevance. Sometimes the relevance is actually relevant to your solution. Sometimes it is relevant just to give us a thought about the provision, to how far deeply we have understood a specific provision. So the word here, the key word here is actual valuation. So we come to realize, okay, gratuity, probably provision has to be disallowed, but what if it is actual valuation? So we get into that mode, right? So the deep thought of that particular provision. So that's what each word in the particular question is important. So here it is provision for gratuity based on actual valuation. And then you have depreciation. So basically, when you say it is debited in the P&L, it is in the books of account. So whatever depreciation has been debited in the books of account. So that's what is provided here. And then you have interest to financial institution. So when you say interest to financial institution, we have certain provisions whereby it says sometimes when it is paid to a financial institution, it is only allowed on payment basis on regular income tax provision. So that is one thing that we need to see, that is interest to financial institution. It says it is unpaid before the filing of return of income. So the section that we immediately remember is 43B. We need to see whether the question requests regular computation or 115 JB computation. See how is it treated in regular computation, how is it treated in 115 JB. So we need to understand that difference. Then we have penalty for infraction law. So there is a penalty involved. So what happens? Should we allow an expenditure if it is related to penalty relating to infraction of law? So basically you have not done something which is required under the law. You have not followed, so for which you are being penalized. Okay, so these are the items debited to P&L account. Then we have items credited to P&L account. So the items credited to P&L account is, the first one is profit of units established in special economic zone. So SEZ. So what is the treatment? Generally, you have tax, some of the units in special economic zone enjoys a tax holiday benefit, right? So their profit is basically exempt for a certain period. Let's say up to 15 years, they can utilize 10 years as tax eligible units. So now, what is the treatment if it is related to income tax provision, that is your regular income tax provision? What is the treatment if it is related to 115 JB? So that we need to see. The next one they have given is share in income of AOP as a member. So what happens relating to an AOP? So probably in this respect, a company is a member of that AOP. So AOP is giving some shares to this company. So what will be the treatment of this particular entity? So what do you do with this share of income? And then you have long-term capital gains. So what do you do with long-term capital gains? That is LTCG. So these are the list of items provided. Mostly, every question of this manner will always have some additional information for us to give probably a specific directions to the line item already provided, or some extra information. So it could just give you an additional information relevant to the list of items that has already been provided, or some extra information as such. So we'll see what it is. So the first one is depreciation. It says 80,000 of depreciation is account of revaluation. So it says it is an account of revaluation. So this we already saw in the earlier slide, that depreciation has been provided, that it's debited to the books of account of so and so amount. Now, in other information, you come to know that out of that amount, 80,000 is related to your revaluation of fixed assets. So that's one of the information. The second one is as per income tax rule. So basically in income tax, whenever you're computing your depreciation under section 32, you will have to allow depreciation computed under that section and disallow depreciation as far as company side goes. So you disallow what has already been provided in your books of account, and you allow what is actually needs to be allowed under Income Tax Act, read with income tax rule. So section 32 provides what are the depreciation that you are eligible for. So accordingly, according to this Ganga Limited, the depreciation as per income tax provisions are 4,12,000. Next one is, it says balance of statement of profit and loss shown in balance sheet. See the word asset side. What do you think is the importance of this word asset side? Basically, when you say carry forward of profit and loss account, let's say a profit is flowing from your P&L to balance sheet. To which side of the balance sheet does it go and sit? It goes into the liability side. It goes into the liability side. It gets added as a reserve, right? So your capital account, your reserve account. So your reserve account includes profit and loss statement, whatever you have earned over the years. So now this is on the liability side. So this is a general phenomenon. Generally, a business tends to make profit. Profit gets accumulated over the period of time, and profits gets reported as reserve under the liability side of the balance sheet. But here the word is asset side, which means it's a loss. So which means it's a loss. So it has got accumulated into the asset side of the balance sheet. Now it says it was 32 lakhs. It gives you a total figure, whatever is appearing in your balance sheet, out of which unabsorbed depreciation is 18 lakhs. So basically, unabsorbed depreciation is what? You have a loss. You try to understand how much is because of depreciation, how much is not because of, like, how much is the other losses that you have made other than the factor of depreciation. So now we know in general income tax provisions, when there is an income tax under the provisions of Income Tax Act, if you have calculated depreciation under section 32, and if you have a loss which is also attributable towards your depreciation, you have unabsorbed depreciation. Why is this important? It can be carried forward for n number of years. This is under your regular income tax provision. But here, this is about the book number. This is about the book number. So whatever has been in the book, right? So it's not about your depreciation related to this particular section. So it's not related to this. So it is only related to your. So it is not related to your income tax depreciation. It is basically related to your book depreciation. What is the loss of due to depreciation? So that is what is given in the another information. The next information that is given to us is the AOP. We said there is a share of AOP provided in the books of accounts that is being received by the company because company is a member. Now it tries to give us an information that such AOP was charged at maximum marginal rate. So what is maximum marginal rate? Just to revise the subject, maximum marginal rate is the highest possible rate for an individual, highest possible surcharge for the individual, highest possible education cess or whatever is there for the individual. So all this put together, if you are calculating tax for such person, such assessee, what would be the rate? That is called as a maximum marginal rate. So if we have 30%, you have maximum surcharge of 37%, and you have a cess commonly for 4%. So all this put together will be called as maximum marginal rate under the income tax provision. So it says this AOP is actually chargeable under the maximum marginal rate. Okay, so that's another information. And we also have another information and which says about provision for income tax. Whatever we saw in the first slide includes interest payable. So the provision for tax, whatever has been provided in that table, includes interest. So that's another point. So based on the information, what are we required to do? We are required to calculate profits, that is minimum alternate tax. So calculate the book profits, apply the applicable tax rates to calculate the tax under section 115 JB. So in this 115 JB, they have also given an alternative. What if Ganga Limited is located in an IFSC? So it is International Financial Service Center. So there are similar to your SEZ. What do you think SEZ means? It says it's a special economic zone, which means it has given a special economical status. What economical status? though it is in the land of India, it is supposed to be treated as a foreign location. Similarly, IFSC is also International Financial Service Center. So as the word says, it is a financial international service center, which is in the operations of financial business. So even if located in India, it is supposed to be a foreign location. So economically, these units such as your SEZ or IFSC, though located in India, will be called as a international unit, international location. So it's like whatever SEZ is doing, it is like an export or import transaction. Similarly, with respect to IFSC. So that is the another option given. What's the treatment if a particular unit is located in IFSC? Okay. There is another option given, another alternate for which we have to work out. It says it is deriving solely income from the convertible foreign exchange, so which means 100%. So 100% of income of that IFSC unit is purely by foreign exchange. So what would be the consequences if dividend is distributed? If dividend is distributed from such unit, what is the consequences? What is the tax position? So what should the tax position be in the hands of Ganga Limited and also in the hands of shareholders? So it's requesting us to calculate or just tell a position. What is it if it is complete income is through a convertible foreign exchange, that is 100% income is a foreign currency income, and it is located in IFSC. So what is the treatment in the hands of the company? What is in the treatment in the hands of the shareholder? So that's what we need to do. Now, we'll try to go back to the question to understand each one of the item and then go to the solution so that we understand the basic provisions of 115 JB. So we'll go back to the first slide. Just give me a moment. Yeah, that's the first page. Yeah. So now, if you see, the first item is provision for loss of subsidiary. We know we are supposed to calculate the profits under tax under section 115 JB. So we need to calculate the book profits. So we know that the profits is actually 52 lakhs. So we are going to start our problem with this 52 lakhs. We are going to add, that is, we are going to disallow or add whatever is not an eligible item as far as the book profit is concerned. We are also going to reduce any incomes which is not allowed in the nature of 115 JB provision. So that's what we are going to do. We're going to start with the expenditure part of it. The first item is provision for loss of subsidiary. So whether it is allowed or not allowed under section 115 JB. So to be precise, provision for loss of subsidiary is not an allowed expenditure. So whatever book profit typically relevant to that entity, that is the particular person or the assessee, that alone should be computed. So whatever is not relevant, whichever is notional, probably we'll put it this manner, wherever there's a notional loss, notional income to a particular subsidiary entity, that is not an allowed expenditure or an income under section 115 JB. So provision for loss of subsidiary is not an allowed expenditure. So probably we'll have to add it back. It's already debited. We are going to add it back. And then it says provision for doubtful debts. 115 JB provides that any unascertained liabilities, let me use this word, unascertained. So anything which is unascertained, which means there is no clear-cut breakup of what it is. It's an estimation. It is just an estimation. There is no reasonable certainty. There is no reasonable certainty involved to it. It is just an estimation or an assumption on what could be the doubtful debt. So it's a provision for doubtful debts, which is also not an allowed expenditure. And then you have provision for income tax. When you say provision for income tax, it is also not allowed. It is a provision. We read in that other information that there is a quantum of interest relating to this tax. Quantum of interest relating to this tax. So what is the quantum? Some quantum, I guess it was 65,000. So now this interest amount, whether allowed or not allowed. We know provision for income tax is not allowed. What about the interest portion? In section 115 JB, they very clearly say when you call provision for income tax, taxes include deferred tax, dividend distribution tax. I'll just write it here, deferred tax, and then you have dividend distribution tax, any interest, any surcharge, or any cess. All of these are categorized as income tax. So any part of it will be disallowed. It is not allowed under the concept of 115 JB. So the provision for income tax also should be disallowed. Next, you have provision for gratuity based on actual valuation. We said the key word here is actual valuation. So what happens when it is actual valuation? What happens when it is not actual valuation? We need to understand that, so that we know the provision very clearly. We're not going by just few words or few basis on what a question was solved in a material or something. We need to understand the provision. The provision says we use the word unascertained liability. Whether actual valuation is ascertained or not ascertained. Is it unascertained or is it ascertained? So that's what we need to solve. So there are various judicial rulings which says if it is based out of an actual valuation, it is an ascertained liability. It is not an unascertained liability. So provision for gratuity through an actual valuation is an ascertained liability. Hence, what should be done? If it is an ascertained liability, nothing needs to be done. It is allowed to be debited. It is allowed as an expenditure. So we are not doing anything with respect to this. So we are just leaving it as it is. Depreciation as per the books of account. So whatever depreciation has been provided in the books of account has to be added back to the your profits, and whatever is an eligible depreciation alone has to be reduced. What is eligible depreciation? Just recollect the question. We saw an information that the depreciation on revaluation of fixed asset was provided in an other information. So that is not allowed. So anything which is going to a revaluation reserve, any depreciation portion that is going into a revaluation reserve is not an allowed depreciation. So depreciation will be added. Whatever has been provided in the books of account will be added, and to the extent of revaluation reserve alone, that is whatever has been revalued alone, will be disallowed. The rest of the depreciation will be allowed. So we need to remove it, and also we'll have to include it as profit. So probably we can say, I'll just use the word minus. So basically, the eligible depreciation, whatever is the eligible depreciation, has to be reduced. So that's what we are meaning by it. The next line item is interest to financial institution. When you say interest to financial institution, we said section 43B. Section 43B. So section 43B says certain expenditure is only allowed on payment basis. So among them, out of the certain payments, one of the payment relates to interest payments to financial institutions and certain state-owned institutions. So government-owned institutions and financial institution. If interest is payable to such institution and it is actually not paid till return filing, it is not allowed. It is subsequently allowed in the year in which such payment is made. So that is what interest is about. So this is under section 43B. But what are the provisions that we are computing? We are computing 115 JB for MAT calculation. MAT doesn't bother whether it falls under 43B or not. So we need not do anything to it, because according to 115 JB, you need not do anything just because something is disallowed under regular provisions of Income Tax Act. So we are not going to do anything about it, because it is only disallowed under section regular provisions under section 43B, and nothing has to be done with respect to your 115 JB computation. So we are not doing anything to this also. So I'll just strike off nothing has to be done. Nothing has to be done to this provisions. Penalty for infraction of law. Again, section 37 in your regular provision says whatever is not in accordance with law, or something which is even illegal, is not an eligible business expenditure. So penalty is not an eligible section 37. So this penalty is not an eligible expenditure under section 37. But what are we computing here? We are computing profits under section 115 JB. So under 115 JB, nothing has to be done, because we are just going by whatever is there in the book profit, similar to what we discussed in section 43B. Similarly, for this section 37 disallowance also, it is only a disallowance in the eyes of income tax provisions, not under the laws of 115 JB. So nothing has to be done for this also. So that is with respect to the first table with respect to the debited to P&L account. So we'll come to the next statement, that is your credited to P&L account. So this, according to this credited to P&L account, the first one is special economic zone. Whether a profit from established a unit from established in SEZ, is it an allowed income or not an allowed income? So income tax says whatever is actually an income in SEZ is also an income under section your 115 JB also. So there is also another clause, right? 115 JB, which is on alternate minimum tax. So in both these sections, when we are calculating the book profit or the actual income, we ignore such incomes which are actually exempt. That is whatever is then eligible under section SEZ or something. So basically, which are eligible for a tax incentive deduction or a tax exemption on unit-based income, on business unit-based income, needs to be accepted as an income under the laws of book profits. The only income that has to be actually ignored is section 10, exempt income under section 10 or section 11 or section 12. Only such income or relevant expenditure must be disallowed under book profits, but anything related to tax incentive holiday units has to be allowed as book profit. So SEZ is a tax holiday unit, so which is an allowed expenditure. So it is an allowed, allowed income, and if there are any expenditure, that is also allowed. So this is an allowed, so we need to do nothing about it. Then you have share of income from AOP as a member. This has to be read in addition to the information that we have been provided. What information was there? It is taxable under maximum marginal rate. So when a particular income of the AOP is taxable under maximum marginal rate, it falls under section 86. So anything under section 86, it says whenever an AOP is taxable under maximum marginal rate, the concerned income is not taxed in the hands of the member, which means it is not an income relating to the company because they are not going to pay tax on that. Since it is already under the provisions of 86, it shall not be taxed in the hands of the member. So again here, this has to be removed. So this income is not part of our book profit. So we need to remove it from the profits. And finally, you have long-term capital gain. Long-term capital gain section of 3,20,000. What should be done? So this 3,20,000 in the 115 JB, it says long-term capital gain section per income other than income under section 10 subsection clause 38. Clause 38 alone is to be an allowed income. The rest of the income are actually probably not allowed income. So this 3,20,000 also has to be adjusted. So that is with respect to this slide. The next one we have discussed all this information. So now we'll go into the solution, whatever is there. So we'll go into the solution. So if you see, it starts with net profit. So it starts with net profit. What we saw in the first slide, it is 52 lakhs. From 52 lakhs, we said we have to add provision for loss of subsidiary. So we are adding. And then we have provision for doubtful debts. So any asset, when we said it's a provision, or even in the aspect of diminution of an asset. So any asset that is being revalued as a diminution or something, that also has to be allowed because it's only a provision. So this also we discussed, being a provision which is unascertained, which is an unascertained liability, needs to be disallowed. And then we said provision for income tax. When we say before that, we discussed provision for gratuity, which is an ascertained liability that is based on actual valuation that need not be adjusted. So it has not been adjusted here. The next item was provision for income tax. As far as provision for income tax goes, we said interest is also part of it. We also said deferred tax, dividend distribution tax, interest, surcharge, and cess. All these 5 items are an eligible portion under section, which has to be disallowed, which has to be added back while computing 115 JB profits. So that is why the entire is added. So that's what is said. It is provided in explanation too. So it's not only interest, as we said, 5 items, part of tax has to be added back while it is being treated as a provision in the books of account. And then we said depreciation has to be added, finally reduced after adjusting the revaluation depreciation. So with that, we have done with the addition. So we have to see what are the reductions. the AOP member. So the AOP member, we said whatever has been charged to the member, whatever has been, since it is already been taxable in the hands of AOP itself, it is not required to be taxed in the hands of the member. So we said, as since it falls under section 86. So when does it fall under section 86? When AOP is taxable at maximum marginal rate. In such scenario, whatever is the income, share of income to that member is already taxed in the hands of AOP in MMR, that is maximum marginal rate. So it need not be double taxed in the hands of the company. So it is reduced. So remember the word double tax. It is already taxed in the hands of AOP. So it is not taxed again in the hands of the company. So this also we discussed, it has to be removed. And then you have depreciation. When we said depreciation on revaluation of asset alone has to be ignored. So this 80,000 is ignored. Out of 3,08,000, 80,000 is removed and you get 2,28,000, right? So that's what you have to do. And then you have, after this, so now we have adjusted everything, whatever we discussed. Long-term capital gain, we said anything related to section 1038 alone has to be adjusted. Any other long-term capital gain need not be adjusted. Why is section 10 clause 38 adjusted? Because it is an exempt income. So it is adjusted. So any other long-term capital gain need not be allowed. And while speaking about the section 10 clause 38, anyways, it is no more applicable because you have section 112A, where long-term capital gain on security transaction tax eligible securities is taxable at a special rate under section 1112A, that is at 10%. So there is no more 1038. So whatever long-term capital gain is provided in the books of account has to be an eligible income under the book profits also. So nothing needs to be done to that long-term capital gain. So that's about it. Now, one another adjustment in your 115JB is adjustments of losses. So let's say you have book loss incurs ordinary loss, that is your, let's say, the business loss, and then you have depreciation loss. So you have both ordinary loss, the business loss, and the depreciation loss. So out of these two losses, while going back to the regular income tax provisions, if you actually could understand, unabsorbed depreciation is carried for n number of years. Whatever is relevant to your book loss are carried for 8 years as a normal business. Whatever is a business, a normal business, it is carried for 8 years. So here in 115JB, it's not like that. It says ordinary book loss or depreciation loss, that is your unabsorbed depreciation or ordinary book loss, whichever is lower can be adjusted to your profits. So here we said the actual profit was 32 lakhs. The actual profit was 32 lakhs, out of which 18 is depreciation. So 14 will be your book loss. So this is depreciation, this is book loss, right? So 14 or 18, whichever is lower. It's not a big max that we need to do. So 14 is the lowest number out of this. So we have to adjust only the 14 lakhs. So we are adjusting 14 lakhs to arrive at what has to be reduced. Giving all this into the impact, you get your book profit calculated under section as required under section 115JB. Now we need to compute the tax part of it. MAT under section 115JB was earlier taxable under 18.5%, but currently from last year, it is taxable at 15%. So this is a new rate. 15% is the new rate applicable. So this 15% has to be applied to the book profit. So this book profit, you apply 15%. Whatever is the relevant surcharge or cess, as under the normal provisions, will fall into the picture. So let's say your regular provision has surcharge, where your total income is crossing 1 crore, it is applicable here also. So here the total income itself only is 40 lakhs. So we need not calculate any surcharge as such. So health and education cess of 4% alone has to be added. So you add cess of 4% and then you get liability, which is rounded off to the nearest tens. So that is your MAT liability. Wherever required, we obviously have to write the notes. So whatever we have discussed is there in the notes. We said according to them, whatever has been adjusted in the books of account can be allowed unless specifically provided that this must not be allowed, that is added back or reduced. Unless that Nothing needs to be done. So the regular whatever items are not specified in the list of items under section 115JB can be adjusted. So we said, though it falls under 37, though it falls under 43B, it is still allowed because it is not specified under section 115JB. And then we also discussed about this gratuity. There is one case that is mentioned, there is one case law that is mentioned, that is SJ Forgings Private Limited, which says that it has to be allowed if it is based on actual valuation. So it is an ascertained liability if it is based on actual valuation. And then related to special economic zone, it need not be adjusted. The second alternative was, what if it is in International Financial Service Center, IFSC, and entirely under convertible finance section. So if it's located in IFSC and the entire income, 100% of income is in convertible foreign exchange, then the rate is 9%. So your rate is 9%. So under 9% is what you have to calculate for the book profit. Similarly, surcharges, everything has to be computed. So in this case, the maximum, the minimum alternate tax rounded off will be 375,150 if it is located under IFSC. So that is with respect to second alternative. So what was the third alternative? What if there is dividend distribution to a particular, to the shareholder? What happens in the hands of company? What happens in the hands of shareholder? So dividend distribution tax is discussed in 115O. Okay, this 115O is now probably the dividend distribution tax is abolished with effect from 31st March 2020. So any dividend paid after from 1st April 2020 is taxable in the hands of the shareholder itself. So this is the provision under 115O1 where DDT is abolished. That dividend distribution tax is not there. But there is another provision, another subsection of 115O, which is 115O8. Okay, 115O subsection 8. This subsection starts with the word notwithstanding anything contained in this particular section. So whatever has been contained in the section, ignore that. You take whatever is provided here as the actual provision. So this 115O8 says notwithstanding. So whenever it is related to an IFSC, subsection 8 comes into picture and you need not go into subsection 1 or something. So what does subsection 8 says? It says whatever is the distributed profits, you need not charge anything both to the company and to the shareholder. What is the condition that has to be satisfied for this? It must be an IFSC unit. It must be a 100% income should be in convertible foreign exchange. So if these two things are satisfied, then from 1st April 2017, this provision said you need not tax. Both the company need not pay dividend distribution tax. It is also not taxable in the hands of the shareholder. So this 115O8 comes into the picture when it is an IFSC. So what does it say? It is not taxable in the company or in the person receiving. So it is either, that is no tax, either in the hands of. So it is not in the hands of both the company and receiving such dividend. So that's the provision. So thus neither the company nor the shareholder needs to bear dividend distribution tax or an income under this. So that's with respect to the first question. So we'll move on to the question 2. So this question 2 is about another manufacturing entity called Lamba Limited. It is established in 1/4/2012. Its statement of profit and loss account is being given. What is the profit? It is 750 lakhs, that is 7.5 crores. After debiting or crediting the following line items. So they're going to give a mix of debiting and crediting. Depreciation charged on the basis of useful life of assets as per Company Act. So what should we do? We should add it back. If it is a regular provision, we should add it back. If it is under 115JB also, we need to add it because book depreciation must be debited. Whatever is allowed other than revaluation alone must be allowed as an eligible depreciation. In regular provisions, whatever is provided under the Income Tax Act alone should be allowed as a depreciation. So industrial power tariff concession, 4.8 lakhs received from Maharashtra statement was credited to P&L. So it is a power tariff concession. Power is basically a revenue item. So it is a revenue item. So any subsidy to a revenue, any subsidy, government subsidy to revenue is an income, is an eligible business income. So whatever is received is an allowed under income tax provision because it is revenue in nature. If it is capital in nature, when is it capital in nature? If the subsidy is for some capital asset, let's say they have bought a land for which government has given some subsidy, then it becomes a capital subsidy. In that case, it must only be reduced from the fixed asset, not claimed as a capital income. So that is what with respect to capital grant is concerned. When it is a revenue grant, it is an income, it is an eligible business income under the laws of Income Tax Act. The company had provided 18 lakhs being fairly estimated with payable with reasonable certainty. So keyword, look for the keywords. It uses the word reasonable certainty. So it says every 3 years. So basically every time they calculate some repayment for this union. So there is recalculation, which is being revised once in 3 years, and that is being paid. So that amount is basically on reasonable certainty. So which means they actually pay. If they say 18 lakhs, they actually pay 18 lakhs to a great extent. Though it may not be 100% accurate, they still try to say it's reasonable certainty. So more or less, it will be a correct number. So when it is reasonable certainty, it is an allowed expenditure in the Income Tax Act, actually. And even when we are speaking about 115JB, any provision which is based on some ascertained liability, it is an allowed expenditure. So this company has provided, they were debited to P&L account with respect to this amount, 18 lakhs. So it is being debited. Dividend receipt from a US company, whether it is a taxable income or not a taxable income. So whatever dividend income, which was earlier exempt, was only the ones which suffered 1150. Dividend distribution tax under 1150, which is basically a domestic company. When a domestic company pays dividend, it pays dividend distribution tax under section 1150. But if it is a foreign company, whatever dividend received is taxable only in the hands of shareholder, even earlier, even now. So there is no change in this provision. If it is a foreign company dividend, it is automatically taxed in the hands of the shareholder only. But the only thing is, this is classified under income from other sources. And then there is some destruction of machine. So there is damage to a machine. It's actually not a sale, it's a damage, but they received some scrap value. The scrap value is 3 lakhs. So whatever the scrap value is 3 lakhs, they say that the insurance company did not accept the claim because saying it is your negligence. So I have nothing to do with this. So I will not give you any insurance claim. So because of this, they have made a loss of 17 lakhs. So this 17 lakhs is a revenue loss or a capital loss? It's a revenue loss or a capital loss? It is from a fixed asset, not stock. It is from a fixed asset. So it is a capital loss. So it is capital in nature. Both this loss and the income, both this and this is capital in nature. So this is also capital. This is also capital. Both of this is capital in nature. So it is not an eligible expenditure or income in your P&L. It has to be removed because it is not revenue in nature. And what is the treatment of sale of asset in your income tax provisions? Basically, this has to be adjusted with your the whatever income that you're receiving. That is your sale consideration. It could be a scrap or whatever sale it is. Whatever income that is being received from that sale of asset needs to be adjusted with your WDV. So that is what your computation for capital gain on depreciation says. So when is a capital gain recognized on such asset? Only when the entire block is no more. All the assets in that block is sold, or only when that block goes negative. That is, your depreciation is on a negative WDV. So that only then, so the zero or negative WDV. So only then such negative WDV will be treated as a loss. So the loss is only treated only on 2 circumstances, loss or profit. So in this case, it should have technically been adjusted to your WDV of your depreciation of that particular machinery. But the question is not very clear whether it has actually done it or not. But as far as this goes, as book adjustment is concerned, 17 lakhs has been treated as a revenue loss. 3 lakhs has been treated as a revenue income. So this has to be adjusted with respect to our computation on normal basis. Provision for gratuity on actual valuation. with respect to your 115 JB, we said if it is an ascertained liability, actual valuation is an ascertained liability, then only that ascertained is an eligible provision, rest are not allowed. But 40A7 or let's say 43B, 43B says gratuity is also allowed under only payment basis. 40A7, any provision on gratuity is not an allowed expenditure. So whatever is only paid is only an allowed expenditure with respect to 40A7 or 43B with respect to gratuity. And then you have an advertisement charge for what it is, souvenir of a political party, whether it is an eligible expenditure or not. Section 37, subsection 2B provides that whatever is relevant to advertisement cost on a souvenir of a political party is not an eligible expenditure. However, this deduction under section 80 GGB. So that is with respect to advertisement charges. And then you have long-term capital gain of 3 lakhs, which is subject to STTT. So what did we say? There is no more section 10, clause 38. Currently, what you have is 1112A. So 1112A says, whatever long-term capital gain is taxable at 10% if such long-term capital gain is from securities or units that are subject to security transaction tax. So if it is subject to security transaction tax, then it is taxable at 10%. So in this case, it says it is subject to security transaction tax. So it is taxable under section 112A at 10%. But in 112A, it says you need to calculate tax on it, but leave the first 1 lakh. So whenever your long-term capital gain is only exceeding 1 lakh, only on that you treat your income. The rest is not actually an income. So basically in this 3 lakhs, only 2 lakh is actually treated as your income. The first 1 lakh will be ignored, which is like there need not be calculated any tax on it. It is 0% up to 1 lakh. So similarly, as we discussed, there are some additional information. What are those? Normal depreciation computed under 71 lakhs. So this is under section 32. It does not say whether it adjusted that scrap of 3 lakhs or not. It did not give any clarity on that. So we can always take an assumption saying that either it was adjusted or not adjusted. So the easiest the assumption is saying that it's already adjusted. So while writing a note for this particular adjustment, we clearly specify that it is assumed that the scrap sales for the purpose of income tax was already adjusted with the WDV of the machinery, and this is calculated after considering such adjustment. So then it is very clear that we understood the provision, we have given effect to the provision also. So this is clearly specifying to the valuer, the paper valuer, that you have understood the provision and carried out a particular problem. Okay, the next is GST of 8 lakhs. So basically they have collected from its customers. So whatever has been collected from customers has been actually paid to the government. But later in a High Court ruling, they said about 3 lakhs, they have said they've written it back. They've said it is not an applicable GST. So relevant 3 lakhs to collected from the customers is written it back. What should you do to this 3 lakhs? This 3 lakhs should actually be returned back to the customer because it is not your money. Whatever GST you are collecting, it is not your money. It is just you're you're just a mediator. You're just a middleman, where you're collecting money from the client and giving it to the government. It is not your money. So the High Court has said 3 lakhs is not a collectible GST. So return it back. Out of this 3 lakhs, they have only returned 2 lakhs. The balance 1 lakh is still lying under the current liability. So they've still not yet paid. So basically, when you have not paid to the particular customer, it becomes your income. It is something like liability, which you are no more probably going to settle. In the year in which maybe you are actually settling it, you can again claim it as an expenditure. But in the year in which you have not settled, it becomes your income. It is something like a deemed income under section 41. So 41 talks about deemed income. So this becomes a deemed income, whereas you have probably not settled to the customer. So it becomes like your income. So this is what under section 41, it becomes a taxable income. So it says compute total income. So it's pretty clearly that we need not compute under 115 JB, because it says assume that the company has not opted for 115 BA. Okay, so if they have actually not opted for 115 BA, then both are applicable. They have to calculate total income, but it only says calculate under the provisions of income tax law. So anyways, we are going to ignore 115 JB. So the relevance of this section 115 BA is probably to calculate the income tax rate applicable. But the only thing is, we need to only compute the total income, so we need not calculate the tax as such. So we'll go into the provisions. So basically, we said first thing is depreciation. Depreciation has to be adjusted. So we discussed this. Depreciation has to be adjusted because the depreciation calculated under section 32 under Income Tax Act needs to be allowed. So that is what there. Provision for payable to workers, we also discussed this. Whenever it has reasonable certainty, it is an allowed expenditure. It need not be disallowed. So it is in line with the disclosure requirement of ICDS 10 on provisions and contingent liability. So ICDS 10 says whenever there is a reliable estimate, So that is nothing but like reasonable certainty. So the word reliable estimate is similar to your reasonable certainty. So reliable estimate of the amount of obligation and reasonable certainty for recognition. So if these both are there, so if both of them, reliable estimate and also while recognizing into the books of account, when there is reasonable certainty. When you say reliable estimated, when I calculated, I've calculated to the point, more or less, I've calculated the exact amount. That is reliable estimate. When I say reasonable certainty, when I'm booking in the books of account, I know for sure I'm actually going to make this payment. So that is what is called as reasonable certainty. So if both of this are applicable to that particular transaction, then it becomes a eligible transaction as far as your income tax provision is concerned. It need not be disallowed. So this is also we discussed. So that's why no adjustment is required. The next one, we spoke about this loss on machinery fire. As far as machinery fire is concerned, we said it is a capital loss. So whenever it is a capital loss, it is not an allowed expenditure in the books of account under section 37. So 37 says any capital in nature is not an allowed expenditure. So there are various criteria in 37, like it should not be in personal in nature, it should not be capital in nature, it should be wholly and exclusively for the business, it should be incurred during the previous year. So it should not be for any other relevant previous year. It should not be personal in nature. It should not be illegal or not under the laws. So these things are basically a not allowed expenditure. Rest of them are allowed. So here it is very clearly, it is capital in nature. Hence, it is not an allowed expenditure in the P&L account. So this 17 lakhs is not an eligible expenditure in income tax provision. So in income tax provisions, the profit or loss on a particular asset has to be recognized. The capital gain on such fixed asset has to be recognized only. What did we say? We said it can be recognized only in two circumstances. One, the entire block was sold. Second, the WDV is nil or going into the negative phase. So only then you can calculate profit or loss in that particular block of asset. Else, you should not recognize it. So being capital in nature, this 17 lakhs is disallowed. Provision for gratuity, we said under section 43B, gratuity is allowed only on payment basis. Similarly, 40A7 also, whatever provision on gratuity is not an eligible expenditure. So here, whatever was paid, actually paid is 70. So only 1.6 crore is paid out of 3.2 crores. So the remaining 1.6 crores should be disallowed. It can always be allowed. It can always be allowed in the year of payment. So in subsequent year, if the question says that certain amount has been paid for some old year, let's say for financial year 17-18 or 18-19, it has been paid in current year, it has to be an allowed payment in that particular year. So here, whatever is disallowed is eligible on payment basis. So whatever is there, eligible on payment basis. So that is with respect to provision for gratuity. So this comes under 40A subsection 7 or 43B. Next, advertisement in souvenir of political party. We said 37 2B, it is not an allowed expenditure. However, we said it is eligible for a deduction. Deduction in chapter 6A. So in chapter 6A, it is an eligible deduction. So you can always claim whatever amount has been donated to political party. There is a condition there. We'll discuss it when we are actually getting into that position of solution. So as far as this goes, it is not an allowed expenditure under section 37 2B. So this 2.3 lakhs is disallowed and added back to the books of the income, added back to the income. So this is the adjusted income as of now. Now we are going to add any income which are actually not thing. So whenever we get into this computation, there are 4 heads, right? So you have expense, you have income. Expense disallowed, expense considered as an expense, that is you reduce. Similarly, income not considered under a business or profession or not at all an income. So you reduce that. Whatever income has to be additionally considered under section, this income tax provision should be added. So this is what you have to do. So you can go in any order, like, so you can first add the expenditure, then reduce the income. So whatever order that you're doing, you have to do 4 things. Whenever you're talking about a PGBP problem under regular income tax provisions, there are 4 adjustments. First is add expenditure that are disallowed under income tax provisions, allow expenses that are allowed under income tax provisions, disallow income which are treated separately. So remove income that are income considered separately or exempt in nature or not at all an income. Then consider the income, add income which are considered as an income under income tax provisions of your PGBP. So this is what is the 4th thing. So we already did this, right? So this we have done. Now we are getting into this. So add income tax, income taxable but not credited to the statement of profit and loss account. So the first one we said section 41, which is a deemed income. So whatever is not actually paid back to the customer, though it is in balance sheet, it has to be considered as an income. However, it can be allowed as an expenditure in the year in which it is actually paid. So that is what we discussed this. The next one is industrial tariff concession. We said whenever it is a revenue subsidy, nothing needs to be done. Whereas this is allowed, but capital subsidy is not allowed. So this being revenue subsidy, it is an allowed income. So nothing has to be done to the computation of profits. And then you have dividend receipt from US company. We said it is a taxable income. So, and it will be taxable under income from other sources. So that is what we discussed. And then next you have scrap value of machinery. So out of the machinery adjustment, we saw 2 adjustments. One is a loss of 17 lakhs, a scrap income of 3 lakhs. So out of these 2 things, we already adjusted the loss of 17 lakhs as being capital in nature. Similarly, 3 lakhs is also capital in nature. 3 lakhs is also capital in nature because income tax says, I'm going to repeat this, profit on sale of a capital asset under capital gain will be a capital gain only in the circumstances that we have mentioned earlier. In this case, the machinery block still continues. So whatever is relevant to this particular adjustment needs to be done because it is capital in nature. So this also we discussed. Long-term capital gain should be added here and considered under 1112A separately. So that's it. We only reduced the depreciation under 71 lakhs of Income Tax Act. So we said that there is assumptions to it, considering that the scrap value of 3 lakhs is actually not is actually already adjusted. So it is assumed that scrap value is already adjusted to derive the 71 lakhs. If not, we accordingly have to suitably adjust the depreciation. So we need to write this note very clearly. Whatever assumption we are taking, we have to specify it. Only then the valuer will know that you have understood the provision and worked out. So that conveying that fact is only through notes in income tax provision. So we have to be very clear at that. So with that, you get the PGBP income. Next, we compute capital gains. Capital gain is basically 112A, which is taxable as 3 lakhs. So we said under 112A, 1 lakh is not taxable. Anything above 1 lakh is taxable at 10% under section 112A. So, and then you have income from other sources. Whatever is received from the foreign company is a taxable income. So that is what we have discussed. Okay, now, so we have the total income, and this we said 80 GGB. The deduction under section 80 GGB, we said whatever donations are being made to political party is an allowed expenditure. Only thing is it cannot be in cash. So it is payment otherwise than by cash. So it has to be any mode otherwise than by cash. Only then it is an allowed deduction. So we have considered here that it is basically through non-cash mode. So it is an allowed deduction under section 80 GGB, that is 2.3 lakhs. So your total income is 9 crore 6 lakhs. So it is above 1 crore, less than 10 crores. So you have surcharge. So we need to calculate surcharge accordingly. So this is what. So we assume that the scrap value has already been adjusted in the WDV. That's why we have not continued. Presuming that the same has already been reduced at the value. So we need to convey this as a fact. So as we said, we can also take another view, but in examination, we do not write both the views. We can take a view and clearly specify it. In case if you are taking the alternate view, question says 15% of 3 lakh has to be adjusted to the depreciation. So which means your depreciation will not be 71 lakhs. It will be 71 lakhs minus 45,000 will be your actual depreciation.